Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside, so it's about using technology, pixels, and binary code with a human and humanizing content.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio. Tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they're not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Earnings season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The Beijing government is currently trying to manufacture a crisis over a practice that has been ongoing for decades. It's really up to Beijing to decide if their rejuvenation, if China's rejuvenation will evolve with international respect or with international condemnation.
Important words from a representative of Taiwan, that on Face the Nation on CBS this weekend. And of course, we're continuing to monitor that story. I believe Enda Curran scheduled to be with us from Hong Kong here in a bit. Lisa, an important adjustment. Thank you to Javier Blas leading our oil coverage for this, where Mr. Curry adjusts at Goldman Sachs.
Yeah, and then we've seen that pretty steadily, although still seeing upside down the line. But what we are seeing is people reducing their short-term targets because of how much we've seen the declines really gain steam despite the tight supplies that we keep talking about, Tom.
Yeah, we see that right now. Let me give you those numbers here. Goldman Sachs from a 135 down to 118, but for next year they sustain at 125, and Amrita Sen with Energy Aspects really giving us the same message here moments ago. Always with the same message as Jack Fitzpatrick of Bloomberg Government. Jack, I spent a good part of the weekend looking into some of the mathematics of the great surprise, and that is the Latino, the Hispanic vote, which has shifted Democrat to Republican. I happen to pick an area I know the geography well of. Thank you to Boulder and CU for that. And that is Pueblo, Colorado, east of Colorado Springs. It is thunderous how the Republicans have taken the Latino vote in selected geographies. How does that change Washington in November?
It definitely plays into the expectations of, one, in November, it helps Republicans in the midterms. It also, I think, in the big picture, aside from picking some interesting races here and there, makes Republicans feel a lot better about the presidential, their chances in the next presidential race. Florida especially, you know, the Hispanic voters of America are not a monolith. If you're talking about a major swing state that has not been quite as swingy lately. Looking at Florida, the Cuban Americans there who are particularly conservative, the people who have been really open to Republicans' arguments about Democrats leaning socialist, as Republicans would call it. It probably is an even bigger factor looking to 2024 than in the midterms, but we have seen it play up in the midterms in primaries as well.
Our Greg Giroux, who's scaringly expert on this, has just been phenomenal. Wasserman, of course, owns the high ground. And I thought Mike Allen at Axios this weekend really had an extended note on this. Is it enough to decide the Senate in November, Jack?
It's very difficult to say.
I agree.
Because there's so many factors playing into the Senate. I think one overriding factor that we still don't know exactly how it's going to play out in Senate races is actually the response to the Supreme Court's Dobbs decision, and we don't know how much that's going to maybe outweigh other concerns. I'm not sure exactly how much the shifting expectations of how Hispanic voters will play specifically in Senate races, but in the long term, it's something Republicans have to be happy about. It's just these midterms are tough to pin down, seeing the struggles of the president and his popularity, but meanwhile growing enthusiasm among Democrats, especially after the Dobbs ruling. We still really don't know what the main story is going to be of the midterms. Obviously, Republicans feel better than Democrats, but there are kind of conflicting narratives right now.
I'll give you another narrative that's conflicting, and it could be a potential driver, and that's gas prices. We've been talking about it all year, but particularly today, as we get a 55th straight, perhaps, if we get the continuing of the streak, decline in gasoline prices in the United States. Is that enough? Tom raised this question earlier. Is that enough to get gasoline prices down to, on average, $4 a gallon, for that to make people feel better enough to give Biden a reprieve on inflation?
I would be skeptical that that's good enough so that people would be overall feeling really good about the economy. It's better for gas prices to be going down than up, obviously, and to have an extended streak is a nice thing, but they're not particularly low. And still, if you just generally look at polling on how people feel about the state of the economy and how Biden has handled the economy, it's fairly negative. There's reason to believe it gets better potentially from here until November, but that's not long enough to anticipate that it absolutely is going to turn around. Right now, overall, the economy, and voters can lump all of these together, and the economy is a net negative for Democrats right now.
Okay, so if it's not long enough to essentially turn around the economic trajectory and the way Americans are feeling about it, is it long enough for any other kind of legislative victory for the Biden administration and the Democrats, or is what we saw passed over the weekend really going to be the extent of it?
This one would be a big one that the Biden administration would campaign on, this bill that just passed the Senate. I don't know if that, again, has an economic effect in the near term that turns things around for them from now until the midterms. It's not an easy path for Democrats from here to the midterms, but this bill, as well as the CHIPS bill that the president's supposed to sign into law tomorrow, the fact that they got those in the span of a week and a half is a big deal for Democrats. More of a long-term issue than something that flips the switch for them immediately ahead of the midterms. But those really are going to be two of their main accomplishments that they'll campaign on, as well as the infrastructure bill that happened earlier.
Jack, thank you so much for the brief, particularly there on Latino voting as we move out to November, and out to 2024. Lisa, I've been waiting for this. It is published moments ago by NBER. You know them as the recession gaugers, but also a terrific research opportunity for all interested in economics. Moments ago, Lisa, David Blanchflower of Dartmouth with Alex Bryson and Jackson Sperling published an updated working paper on not unemployment in America, Lisa, but underemployment. Blanchflower is heated that we get our analysis wrong, and particularly in the linkage of wage inflation.
Does he basically talk about a slack that we're perhaps not tracking in the market, and that's why the labor market isn't as robust as people are saying? Because that's been his argument for a long time, and why he thinks the Fed is making a mistake by going too far, too fast, by hiking at all.
It is a partition versus a homogenous study, and his partition is part-time people that want to be full-time people. Blanchflower would say that's definitive in a lot more of America than anybody wants to look at when they bundle in all of the studies. Of course, that's part of the bang-up jobs report we saw a few days ago. Futures up 18, they advance. This is Bloomberg. Good morning.
Record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance on a Monday before Inflation Wednesday. Huge data point Wednesday. Some would say bigger than the jobs report that we saw on Friday. And look what that did. John Farrell off at least today. We're unsure where he's going to be tomorrow. I believe he's stuck at the Naples airport off of Capri, but delays and all that. Kaylee Line's in today, at least right now. Futures up 16, up 18 moments ago. The VIX under 22 gets my attention. And I do want to mention something we've been remiss on in the last 90 minutes, and that is dollar dynamics with a huge resiliency to the dollar off the jobs report. A churning today with a 106 level on DXY, euro 101.93, and yen 134.78. Just to look at the major pairs, I should note Turkish lira holding at 18 lira per dollar, 17.96 on Turkish lira. I think that was enough of an aggregated data check.
Hold on a second. Can I actually offer up a little bit of a fact check here? John is going to be stuck in Capri all week. He is going to be permanently stuck there. We have the privilege of having Kaylee with us for the whole week, unless she runs away because she's thinking, oh my goodness, you know, if John comes back from Capri, which he will not. So Tom, just want to give that little clarification.
I thought he was on Halls for one day.
That's an American holiday.
He just was on Halls like 2 weeks ago.
He's European. All right, well, let's move on. Let's take a look at some of the stocks. We've been talking all morning how it is Merger Monday, which is fascinating because it hasn't been Merger Monday for quite a while. So let's look at some of the mergers. CVS Health talking about buying Signify as they expand into home health care. And you can see Signify shares popping more than 16% ahead of the open. CVS shares a little change, down about 0.25%. Nothing to write home about. And really, the Emerson story is that Whirlpool is going to buy this company. Those shares up a little more than 1%. That's not the story. The story is that Tom Keene has a garbage disposal unit in his apartment in New York City, so I'm going to bring all of my cucumber peels for your apartment, and we can discuss.
Got a waiver on that.
I will try. Also in the news very much today is that bill that was passed by the Senate, now heading to the House. We could see that Tesla and Rivian both benefiting from some of the potential electric vehicle credits. Tesla shares up 1.6%. Rivian, which has been completely hammered. I mean, take a look at those shares. They've been absolutely decimated, up 1.4%. A pretty nominal move considering how much they've been tanked. And Global Blood Therapeutics, Tom, you were talking about this earlier. It really is a fascinating deal. Pfizer planning to buy this company that has some groundbreaking sickle cell anemia treatments at a time when a lot of people are looking to the new advancements in the pharmaceutical industry post-COVID.
Interesting to see that. Right now on fixed income, we're going to drive to Mark Cabana, head of U.S. rate strategy at Bank of America Global Research. This is a timely update on where we are and where we're heading. Mark, let me go with a general question here. In your research this weekend, in your writing, what is the distinction of the Bank of America view?
So the Bank of America view has been very cautious on the outlook, expecting to see a slowdown in the labor market and ultimately see that weigh on consumer spending and then business spending. However, the data that we got on Friday was incredibly strong, much stronger than we in consensus were anticipating, really much stronger than anybody on the street seems to have been anticipating. And it does question how quickly we're going to ultimately see that slowdown. Right. If the labor market is indeed this resilient.
And this links into Savita Subramanian's work in the equity market as well. Mark, there's a wide gap between those looking for 4% up Fed outcome and let's call it a 2.5% to 3% Fed outcome. How do our listeners and viewers actually play this massive diversion in outlook?
Yeah, well, just like the Fed, unfortunately, I think that investors have to be very data dependent right now. But what the data is showing us in the U.S. is that we're not seeing enough of a slowdown yet for the Fed yet to call the quits. So the Fed, as they've signaled, they're going to keep raising interest rates. We now think 50 in September, another 50 in November, and then 25 in December before they're finished. That's 125 basis points of additional hikes this year. It seems like the market is anticipating something similar. But the question is, how long can the Fed sustain these elevated rates? The market is certainly skeptical, pricing in cuts in the second half of next year, and we think that's right. We also question how sustainable these elevated levels of short-term interest rates will be, and that's one of the reasons why you're seeing the curve so inverted. It seems like the curve certainly agrees with this notion that, yeah, the Fed may be able to raise rates today, but that's going to mean a slowdown tomorrow, and it's not going to be sustained. The Fed's going to have to be cutting at some point in order to prevent the economy from slowing too much.
Mark, I'm glad you mentioned inversion. I have the yield curve in front of me right now, and I'm looking at more than 42 basis points. That is how much higher the 2-year yield is than the 10-year yield. Typically, this portends recession, usually within as soon as 9 months. Where do you see this basically as a predictor of some sort of downturn? How long do we have? Does the depth of the yield curve inversion signify some sort of significant downturn or the magnitude therein?
So it certainly signals that the Fed is not going to be able to sustain the level of short-term interest rates that the market is currently implying. That, we think, is clear and unambiguous. As you know, inversions typically precede recessions, but not always. There's a great phrase in the bond market, something like the yield curve has predicted 10 out of the last 5 recessions, or something to that effect. So it's not always the case, but it does tend to be a pretty good indicator that things will slow down. And what it is clearly indicating is that the Fed will not be able to sustain the very elevated level of short-term interest rates for all that long. And we certainly agree with that. Recession or not, we can debate. The BofA view is that we do think we're headed into one. But regardless, the yield curve is certainly indicating that the Fed won't be able to sustain these levels for all that long.
I'm kind of confused. I got to say, I'm trying to put together this idea that you think that the numbers were too high for the jobs report and that they've got to come down. And you think the Fed's going to pivot next year. What's going to make them pivot if we're seeing CPI potentially even at 8.7%, which is the consensus, which is still so far above that 2% level?
Yeah, so we think that, look, the labor market right now is very strong. Inflation is very high, but importantly, what's going to get the Fed to pivot is that both of those are going to come down. We do believe that the Fed will be successful at generating a slowdown in the labor market. We do believe that the tightening of financial conditions that we have already seen is likely causing certainly employers to rethink CapEx, employers to rethink hiring plans. And we do think that that's going to manifest itself over time. It's also going to weigh on the consumer, and that's going to help bring down both the elevated inflation that we see today, and it's going to allow for the labor market to ease to some extent. But look, those are two core tenets of our views. And if we're wrong, then the overall level of rates has to be higher in the economy. But we think we will indeed see that slowdown. We don't think it's going to be all that far away. That's what's ultimately going to allow then the Fed to pause and ultimately shift to rate cuts later next year.
Okay, so until we get to that point where we have some clarity as to whether or not the Fed has accomplished what it set out to do, Mark, how much volatility can we expect to continue seeing in the bond market? Because it has been dramatic, to say the least.
I know. It's been exhausting. It's been an exhausting 2022, I think, for everybody really in financial markets and especially in the bond market. But we do expect that as the Fed sees some signs that the economy is slowing, we think that you're going to see interest rate volatility start to moderate, at least peak and then ultimately decline. The fixed income market really moved in that direction a bit after the July FOMC meeting, where Powell indicated that they're probably going to move slower once they're above their perceived level of nominal neutral. And we still think that the Fed is biased to do that. Having a Fed that ultimately slows down, even if it means 50 basis point rate increases in September or maybe November, that will help decrease overall volatility until there is more clarity on the overall economic outlook. Look, it's not unusual to see elevated economic volatility, to see really mixed messages from the data when you're at this part of a cycle where you're near the end of a broad expansion. And we do think that as, again, we see clearer signs that the deceleration is upon us, the Fed is going to be able to signal that they will begin to slow things down, and ultimately that will lower implied volatility and realized volatility in the fixed income market.
Okay, so if overall movement will be subdued, what trajectory is it going to be from here, Mark? If you're talking about getting to 3.5 to 3.75% by year end, where does that put the 10-year?
Yeah, so for our 10-year forecasts, look, we think that they're going to end the year right around here. We've been of the view that 10s will end the year at 2.75%. And that the curve is going to probably run the risk of becoming even more inverted, at least in the near term. Again, as the Fed signals that they really want to move rates higher in order to slow the economy, and then they'll ultimately get the outcome that they want, and that's going to mean that they're going to be cutting next year and probably into 2024. So 10s, we think, are going to be somewhat stuck around these levels, and we've been encouraging clients to lean long duration because there will be a slowdown coming. The Fed will be successful, and that's just going to limit how high 10s can ultimately move.
Well, let me ask you a historic question around that. I'm looking at acceleration of inversion, Mark, that harkens back to June of 1980. If we get the speed of inversion you're talking about, is Powell like Volcker?
So, look, Powell wants to be like Volcker in that he wants to ensure price stability. He doesn't necessarily want to engineer as sharp of an economic slowdown as Volcker needed in order to get that, but he's going to do what it takes in order to see inflation moderate. Now, the good thing is that the market and surveys of consumers generally suggest that the Fed is still credible. I mean, look at the tips market. The tips market is not pricing in any type of concern about runaway inflation today.
Right.
We'll get another update in the UMich survey on Friday. The most recent reading on that suggested that, five-year forward inflation was also expected to be somewhat limited. And because of that, because the Fed is seen as so credible, that really does help them likely not have to go to the same extremes that Volcker did. But I think Powell would very much appreciate the comparison of him to Volcker if it does mean that he's got those inflation-fighting credentials.
Mark, thanks for the update. Mark Urbano with us with Bank of America Global Research there with a real caution, I would say, across equities and bonds as well. Futures up 18, Dow futures up 116. The VIX churning here with a 21 level. That gets my attention as well. And yes, in the yield space, wow, 3.23%, the 2-year yield. On Washington, Libby Cantrell in the 8:30 moment. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden and his party finally got the win they've been waiting for. The Senate passed the Democrats' landmark tax, climate, and healthcare bill. The House is expected to pass the measure on Friday. It's a slimmed-down version of the $10 trillion plan progressives had sought more than a year ago. Now the question is whether it can give Democrats a boost going into November's congressional elections. China signaled that military activity around Taiwan was continuing past those drills announced in the wake of House Speaker Nancy Pelosi's visit. The Chinese military says it conducted anti-submarine and naval strike exercises today. The recent maneuvers near Taiwan have been the most provocative in decades. And Egypt has mediated an end to 3 days of violence between Israel and Islamic Jihad. The fighting left 44 people dead in the Gaza Strip, and it sent thousands of Israelis into shelters to avoid almost 1,000 rockets fired into Israel. The confrontation began last week when Israel killed an Islamic Jihad leader. And Whirlpool will buy Emerson Electric's waste disposal business in a $3 billion transaction. The business known as Incinerator makes garbage disposal products, instant hot water taps, and water filters. Whirlpool said last month that demand for appliances has dipped and would likely remain suppressed through this year. Warren Buffett bought the dip in the second quarter. His Berkshire Hathaway jumped on the market slump and was a net buyer of equities, reporting $3.8 billion in purchases. That made only a slight dent in its cash pile. Berkshire had $105.4 billion at the end of June, hardly moving from the $106 billion at the end of the first quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
what's the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Differences between Taiwan and the mainland need to be resolved peacefully. And what we've seen China do over the last few years is move away from a peaceful resolution of differences to doing so coercively and potentially forcefully.
The Secretary of State, Antony Blinken, they're on a tour of China. He's been very, very forceful. It's been interesting to see, including a first meeting with Mr. Marcos Jr. In the Philippines. It's certainly an historic moment to see Marcos take the leadership of the Philippines after many, many years. Right now on China, and Lisa read more on China this week, and I was more focused on the tots and you know how they did with Southampton
and your garbage disposal.
Yeah, what was amazing, Lisa, was Pharaoh was at the game, and you know he texted me from the Marmite box on his way to Capri, and you know he got tickets somehow.
The Marmite box.
He's at the Marmite box, so it was good to see that 4-1 as the tots take it out. So Lisa, why don't you lead off with Mr. Curran in Hong Kong here on the disruption in China?
Well, so we've been talking a lot about what's going on with the Taiwan airstrikes, or not the airstrikes, the sorties being operated to send a warning shot as retaliation for Nancy Pelosi's visit to Taiwan. Enda Curran, who is our Asian correspondent for all things economics, the more interesting aspect over the weekend to me was the trade balance data, which suggested a record trade surplus for China, even though imports from the U.S. are falling. What gives? Why does this sort of represent strength at a time when all other signs point to weakness in China?
So you're right, Lisa. It was a surprise number, a bumper figure for Chinese exports. Like I mentioned, some of it is being put down to that post-lockdown rebound still underway. So we know that, supply chains have been improving, factories coming back online, etc. So some of it's been put down to that. There's also talk of solid demand, like in Southeast Asia, for example, and other parts of the region. But nonetheless, it doesn't quite gel with the indicators we're getting in the forward indicators, for example, in the PMIs. Some of the analysts, I think it was Pantheon today, making the point that actually some of this could be down to China's energy exports, inflating the overall number. But regardless of how you slice and dice it, a lot of people are saying, nonetheless, that the merchandise goods story out of China will cool off into the second half of this year and probably cool off quite sharply, reflecting inventories globally, reflecting interest rates and inflation globally. So, a big surprise in the China export story, some devil in the detail, but I don't think anybody really expects it to remain as strong as we head into the back end of this year.
Yeah, the Pantheon data highlighting that China is exporting a lot of oil goods to Europe and to Japan and other Asian nations, and they are a net importer of Russian oil, allegedly, and they could be exporting their refined goods and taking the arbitrage. That aside, there is a question about whether the CCP will move away from zero COVID after November. This is something Joyce Chang was talking about, as well as Amrita Sen, in terms of increasing demand for oil and increasing some of the uncertainty later in the year. How much is Hong Kong a template for that versus an outlier as they move to curb some of the quarantine requirements?
Well, it is a big question, Lisa. So we did have movement on the quarantine restrictions in Hong Kong today. It's been cut back now to 3 days in a hotel and then 4 days of self-monitoring with some conditions attached effectively. Now, so on a headline basis, you'd say that's clearly a positive for Hong Kong. It will help mobility. It will help the residents on the ground here. But nonetheless, though, it's still, quarantine for 3 days. The rest of the world, much of the rest of the world has moved on. Much of the rest of the world's financial centers have moved on. There is a debate over how come this is happening? How come China is allowing Hong Kong to go this way? Are they using Hong Kong as something of a petri dish? Well, we do know that from the top down, when President Xi came here a few weeks ago, he did make the point that Hong Kong has some wriggle room on this under the so-called one country, two systems. So perhaps the authorities here are using that wriggle room. But there is a view that China is also watching closely what happens here as a model for their own eventual exit.
And a completely unfair question. Does China have a Dr. Fauci? I mean, who's, Butch Cassidy and the Sundance Kid? Who are those guys? Who's actually making COVID policy in China?
Well, they do have their own prominent scientists. They have the head of their own disease agency, just like the US and others do, Tom. And some of these, both present and former officials, are quite high profile on China's social media. But of course, the big debate with China is, okay, you've got the science and the health aspect to it, but how much of it ultimately is being driven by the politics? And the politics being that China has reaped a big dividend, a public health dividend and an economic dividend out of COVID-0 until this year, at least. This year has been a big test of it. But at the same time, they're at a point now where if they do let it go, we'll say the way the Western world, so to speak, is gone, then obviously they will face a pretty big disruptive exit wave and, of course, the risk of fatalities that go with that. But above it all, we all know the story, which is the big Congress, the most important political event in a decade, Citigroup call it. That's due to go ahead at some point later this year, maybe November. Obviously, the authorities don't want a public health disaster ahead of that. So I think that's, to answer your point, I mean, the scientists are there, they do have their say, but the ultimate driver of this at the moment, I do think, seems to be more politics than anything else.
Well, and we know that the pandemic isn't the only political problem for Xi Jinping. There's also turmoil in the property sector. And how much more stimulus and supportive measures can we realistically expect before that Congress, considering that is the situation that looks like it's just rapidly deteriorating every single day?
It does seem that it will be somewhat tempered. I mean, the statements we've had from the Politburo and other official commentaries making the point that the government is willing to tolerate some economic pain as long as they can keep things somewhat stable, So, put a floor under the housing sector, which, as you say, isn't evidently clear that they have done that yet, but they're trying to put a floor under that sector, put a floor under consumer sentiment, keep things ticking over. Economists talking about maybe 4% growth rate. Obviously, that's much slower than it has been and will be well below the government's target, which is unusual. But nonetheless, though, it stops the economy falling into a hole. But we're not getting signals or narrative that the old growth model that people talk about in China, whereby the government comes along and puts a lot of money into the economy, just spends left and right, maybe on infrastructure in particular, in the way it has done in the past. That particular cycle doesn't feel like it is coming this time. They're trying to manage, they're trying to navigate, and they're trying not to fall further into that debt trap that is a problem for China's economy.
And thank you so much for the brief and your late evening. Enda Curran with us here from Hong Kong. Lisa, in all the reading of the weekend, and as you dive into a week, and particularly with inflation reports on Wednesday, there can be one sentence that sticks out. This is from Peter Bookvar over at Bleakley Advisory. And this is on the BBC, Lisa, and this is the head of JetBlue, Robin Hayes, saying, I now need to overhire. To me, that is a fascinating sentence about the labor economy to come and wage dynamics.
Basically, speaking to the Great Resignation, talking about attrition, talking about how in order to have the qualified people that they need and to be able to keep their planes operating so you don't get stuck on the tarmac heading to Atlanta instead of Puerto Rico, that you need to have an overfilled bench of potential people. And you're seeing this across the board. How much are companies going to avoid firing in the downturn in order to get ahead of this whole trend?
And as Mr. Hayes says, to overhire, absolutely fascinating. That quote just stopped me in my tracks. Thank you, Peter Bookvar, for that. Futures advance up 18 has become up 24. Well, I guess it's a bull market. This is Bloomberg. Good morning.
I think we need to think differently about, being enough. I think, in a number of different respects, I think, we're trying to either prove ourselves or do too much. I think we have to realize that, as Black people, despite what society says about us, despite, what happens, we are enough. And so I think going forward in that headspace, I think is really important.
I think the pandemic really highlighted the importance of financial literacy. And in that, it's so important to understand, okay, like how do we budget? How do we plan for, unforeseen circumstances and really make sure that we're prepared for these events in the future. And through Blackstone Capital, that's why we really place a big emphasis on financial literacy in all forms, budgeting, retirement, investing, etc.
What motivates you guys to do this?
I think it's honestly the impact that we've already seen. It's something that we just want to keep going because we've seen students come in, learn everything that we teach them, and get really successful jobs on Wall Street, really change their trajectory, their career path. And so if we can keep doing that for the next 100 years, that's something that's satisfying for me.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to
have much more customization on clients' portfolios. And that's a good thing, but it's a challenge to kind of move into that mode.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
It's important to recognize that when you're in bear markets, they don't go straight down. They have ratchets.
This rally could continue for a little bit longer, but we wouldn't chase it.
The market seems to be more convinced that inflation is close to a peak.
Core inflation that really represents how tight the domestic economy is still rising.
I think inflation is going to slow organically.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Merger Monday ahead of CPI Wednesday and University of Michigan Friday. From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John Farrow out all week, not just today. And Kaylee Lyons, very much. We are grateful to have her in the studio all week, not just today. And Tom Keene, what I am struck by is the stubbornness of this rally despite the wall of worry.
Listen to you. It sounds like the gloom from Bramo, folks. You know what it is? Let's look at it now. The persistency of the rally is remarkable. Off of June 16th, SPX is now up 14% off the futures this morning. Since July 1, up 10%. In the first few days of August, even we had on 1.2%. I'm sorry, Lisa, futures up 23.
Yeah, so are you all out of triple leverage to all cash? Or
Nope,
do you see
still
the
there.
wall of worry as having legitimacy beyond September, beyond October, beyond November, when we start to assess the Fed pivot, when we start to assess whether the labor market can retain the strength?
It's the ambiguity on the Jackson Hole, and the ambiguity is framed by the Fed parlor game, which is what, a terminal rate of 2.5%, 2.75%, 3%, and way out, Anna Wong of Bloomberg Economics out at a 5-ish, 4.75%. I mean, the gamesmanship here, Lisa, into Q4, we've never seen.
Yeah, especially at a time when oil prices have been swinging so wildly. And I got to say, Kaylee, that has been one of the most undertold stories of the past few weeks with this rally. The idea that oil went from well above $100 a barrel, no matter which way you slice it, Brent or WTI, to below $90 and heading even lower on the NYMEX. How much do we see that fueling this perception of rolling off in inflation?
Well, that on the headline, yeah, absolutely. And same with food prices, which have come down substantially as well. Then it becomes about core and those sticky price pressures that the Fed is going to have to contend with, because what started as just gas and groceries has broadened out in this economy. That is something that the Fed continually is saying, we're not done yet in trying to fight. We are going to continue to push to get inflation lower. Raises a question of if the market has it wrong, if the Fed just has some kind of communication problem. But the yield curve inverted by 43 basis points right now on 2s10s.
Tom, what did you make of Amrita Sen basically saying that by the end of this year, we're going to end up with still that $120 a barrel, and that you're going to get the roll-off of the SPR, you're going to get China back online because they're going to get rid of the zero COVID to some degree, or at least soften it, and suddenly the scene changes?
Let's take a moment here, Lisa, because I think this is really important. It reaffirms who Jeff Curry with 120-ish call for 2023 as well at Goldman Sachs. The arch call of those that look for higher oil prices is on the demand side. It's not the romance of what Saudi Arabia doing or Russia, da-da-da. It's about demand, and particularly emerging market demand. COVID will end. China will do better in some way, and that will bring on oil demand. That's the core of their thesis.
Well, and we're looking right now to see how that plays out at this persistent moment of gains. And just going through some of the gains, and Tom, you were talking about it earlier, we are seeing it continue to mount heading into the open with the NASDAQ up 0.7%, the S&P doing a little less good, but still up at nearly 0.6% on this merger Monday, which we really have to get into, just really deepening our understanding of Tom Keen's garbage disposal that he owns and Emerson's purchase by Whirlpool. We are seeing the 10-year continue to go down. And Tom, you've been talking about this, 2.79% at a time where the 2-year well above 3%, that curve inversion feeding some of that wall of worry.
Single most important data point before we get to Matt Brill, Lisa, is 43 basis points. Let me define that right now for those removed from global Wall Street. The difference in yield between the 2-year and the 10-year, which is 0.43 percentage points. As Lisa knows, you move the decimal point over. She did this years ago at Chicago Constitutional Law. Lisa, help me here. You move the decimal point over to hundredths, and it's 43 basis points is what Randy Krosner would say.
Yeah, what we're looking at right now is a little bit less than half a percentage point that is.
Did the walls shake when you walked into Booth School years ago? Did the walls shake?
I'm not sure where to go with that, Tom. I don't really recall, but I will say we do have someone who can recall that yield curve and give us some insight into how low it can go and how negative, how inverted, and what the meaning behind it is. Matt Brill, who covers all things rates, all things fixed income, head of North America Investment Grade and senior portfolio manager at Invesco. Matt, how much are you looking at this yield curve and getting a little uncomfortable with its inversion, given the optimism that you're seeing in earnings and in certainly the credit space as well as stocks?
Yeah, good morning, Lisa. It's been a really interesting time for rates, and it's always funny to me when our traders refer to days like today as seeing more curve flattening, and I'm saying, well, is it actually flattening, or are we just more inverting? Because at this point, when you're already negative, you're actually not flattening. You're going even more negative. So when I look at the rates curve, it's telling you that over the near period of time, the Fed has got more work to do, but longer period of time, people believe the Fed is going to get things done, and you're going to see 10-year Treasuries kind of stay anchored around this high 2s. Anytime we get to 3%, we feel like it's a good period to be buying. Overall, the economy is still actually doing pretty good. The numbers you saw on Friday were good. And the big question right now is always, is good good? And I think absolutely. Right now, for the credit market, good is good. And we did not want to see jobs falling off a cliff. We didn't want to see the economy falling apart. And we got a really good number Friday, which makes us feel actually pretty good about things.
So what gives people conviction that we're going to get back down to 2% so quickly, which is what you're seeing in Fed funds futures and what you're seeing at least in interest rate swaps down the line? How much do you have conviction that they will do that without crashing the economy, basically the underpinnings of why credit is holding in and rallying to such a huge degree?
Yeah, so we're seeing some interesting things, particularly from corporations, that you would normally expect them to just start pulling back right now, start cutting jobs, stop investing. But we're actually seeing corporations invest. CapEx in certain particular places is going up. So you're seeing spending on inventory management. You're seeing spending on supply chain. You're seeing spending on renewables and batteries and things like that. So there's a lot of different ways that companies are spending money, which is good, because otherwise you would start to feel as if like this inflation was just going to be just a complete, a very difficult time for them to overcome. But they're spending money to get down costs. And once this eventually takes place, that's going to flow through. And it's going to be good for the longer term for overall inflation. And we do feel like the Fed is going to be aggressive. They're going to be ahead of this. The economy is going to be slow, but it's not going to slow so much that you're just going to see demand fall off a cliff. You're going to see more of the supply get more back in balance with the overall demand.
On the subject of supply, what are your expectations for issuance as we move through the rest of the year, Matt?
So corporate issuance has been really, really strong in investment grade over the last month or so. It's been basically non-existent in high yield. Just last week on Thursday, we had the big Meta deal out in the U.S. investment grade market, the first time that they issued. They issued $10 billion. There's over $30 billion in demand. So you get a new name, highly rated name, did very, very well from a demand standpoint. The high yield market, the supply in the high yield market is off about 70% year to date. So it's been basically closed. We did see 2 deals at the end of last week, chartered another one. So maybe we're starting to see things thaw out there. There is enough demand now, I believe, to start seeing deals come in the high yield market. On the investment grade side of things, it's been mainly the banks. The banks continue to come and really have been flooding the market, which is providing some interesting value. It's been a bit of a value trap all year long because they keep issuing more. But overall, I would say at some point, the banks are going to run out of having to issue, and you should start to see credit spreads there firm up.
Okay, and final question, just as we kind of talk about a Fed that you say is going to continue to be aggressive, the specter of a recession coming down the line, is that going to bring defaults this cycle, or do you think the risk of that is relatively low given the position of strength we were coming from?
So I think we're not going to be seeing significant defaults. We're really not going to see any downgrades probably till the early part of 2023. And that comes back to my statement of earlier of good is good. You know, companies don't default because there's too much employment. You know, that just doesn't happen. So we're in a period of time where, yes, it's not Goldilocks. You'd prefer to see wage inflation be a little less. But as corporations are investing, as corporations are hiring, that's not going to lead to defaults. Now, if energy were to completely fall over, you know, that'd be another story. But we're in a much better spot in energy than we were back in 2015 and 2018 as well.
Matt Brill, thank you so much. I greatly appreciate that this morning. Matt Brill's with Invesco. Thank you again. Lisa, this is below the headlines, but it's really important for the Apple community. Our Mark Gurman owns the high ground on reporting the tone, and he has an absolute tour de force in his message, which has gone viral this morning in technology. Lisa, just to the chase of the two children at the Abramo house. The new iWatch is scheduled for September. Okay, I think that's the news you and I need to know.
If they're watching this, just mute it right now.
You know, the new iWatch is September, and there's iOS, iPad. But in here, Lisa, is something really important. Gurman's got all his radar up on a thing called Stage Manager. This is a mystery. Stage Manager is a huge mystery in the Apple Q3, Q4, and this is a software compendium that is, to be polite, problematic. That's the first I've heard of it.
Stage Manager. Maybe it'll be a surveillance stage manager. Will be a little iWatch.
He doesn't mince words. He says this thing is challenged. They're struggling.
Well, this is the question, right? How much is some of the softening that we've seen in certain sales that Apple has produced, how much is that driven by certain models that haven't been as popular versus a secular slowdown in those purchases? They've held up really well. They've beat expectations, but that sale in China where they cut prices on certain products was really noteworthy for that very question. So how much are future products going to be able to be the home runs that previous ones have?
Do a data check here. You need to know oil south, 88.27 on West Texas Intermediate. We need to do the equity market, green on the screen. Bramo's gone long, futures up 24, Dow futures up 151. We got a 0.7% up move on NASDAQ 100, the VIX 21.49. This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Senate has passed a landmark tax, climate and healthcare bill, giving President Biden a victory on his domestic agenda. Still, the measure is a shadow of the $10 trillion plan that progressives had hoped for more than a year ago. The bill now goes to the House, where the Democratic majority is expected to pass it on Friday. A surprise change at the top of private equity giant Carlyle Group. CEO Koo-Sung Lee has stepped down. Lee's 5-year employment contract was due to expire at the end of the year. Bloomberg's learned that Lee and Carlyle's board had clashed over the contract in recent discussions. The firm's co-founder Bill Conway will step in as interim CEO. Hong Kong has reduced the amount of time travelers entering the city must spend in hotel quarantine from 7 days to 3. That's a greater than expected easing of its strict travel curbs, but Hong Kong is still an outlier in a world that's mostly reverted to pre-pandemic movement. Pfizer has agreed to buy Global Blood Therapeutics in a deal valued at about $5.4 billion. That will give Pfizer one of the few approved treatments for sickle cell disease. The disorder affects 20 million people globally, including many who are Black. Whirlpool will buy Emerson Electric's waste disposal business in a $3 billion transaction. The business, known as Incinerator, makes garbage disposal products, instant hot water taps, and water filters. Whirlpool said last month that demand for appliances has dipped and would likely remain suppressed through this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Big Tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority. Wall Street prepares for the latest read on inflation.
We're all pumped for a happy CPI day.
Will headline inflation ease as expected?
If you get something that comes in much lighter, this rally that we're seeing, we think it will continue.
Instant reaction on Bloomberg surveillance.
That headline CPI figure.
That's going to be a scary number. That is an upside surprise.
And what it means for the Fed.
The Fed is not about to pivot.
Powell is willing to push this as far as needed.
Inflation in Focus, Wednesday on Bloomberg.
Wage inflation unambiguously after this number, accelerating after this number, after the ECI, after the Atlanta Fed. We have, by every reasonable measure of core inflation, inflation running somewhere plus or minus 5%.
The path from 9% down to the mystery of a 2% when Lawrence Summers there, the former Treasury Secretary of the United States, president of Harvard, I should mention as well, a modest acquaintance with economics, and talking there about the glide path and what do we do? Pick your number, 5% or 6%, et cetera. Lisa Bramwitz, Tom King, Jonathan Farrell off today. I guess to the end of the week. I thought it was just a one-day hauls, but what do I know? Kaylee Lyons with us as well. And right now we're going to recalibrate into the Wednesday inflation report with Dana Peterson. She's chief economist at the Conference Board, with all of the ability of the Conference Board to look at a different set of data out there. And I want to go, Dana, I know Lisa's really focused on a job-full economy, but I want to go to your call for restriction by the Fed after Jackson Hole. Are we going to calibrate for September 1 after Jackson Hole? Do we just need to get to Wyoming before we can look to the Fed meeting?
Well, Wyoming certainly is beautiful, but I think that the Fed is certainly data dependent. We're going to get several more readings on inflation, another jobs report, certainly updates on GDP. And I think the Fed is going to be looking at all of these indicators to determine whether or not it needs to go another 75 basis points or 50 basis points. But I think whatever it is, the Fed is going to continue to raise interest rates to really arrest inflation.
I mean, let's do the math here. If it's 175 beat move, or it's 250 beat moves, which is a stick, I get it. But what's a so what? Whether it's one move or two moves is a precursor to restriction. Does it matter?
Well, I think, just getting above 3% on the Fed funds rate, that's restriction. And, we can sit around and argue about it, but I think the fact
we don't do that on surveillance.
The fact that the Fed's been raising rates this aggressively, this quickly, it certainly is going to feel restrictive. We're already seeing that show up in the GDP data.
Dana, do you buy the data that we get on Friday? We heard Peter Scheer just earlier saying that the data doesn't seem to cohere with some of the granular, on-the-ground specific inputs. So do you think that it's going to get revised a lot lower and is going to give a less rosy picture of the labor market?
Well, how much can you revise down? That was an astounding number. More than 500,000 jobs added in July. That would be a huge downward revision. And whatever the revisions are, they're probably going to be minor. What the labor market's telling us is that we still have a very strong labor market. Many people are seeing their wages rise. Many people are being hired, especially in those in-person services that struggle to find workers. It's really astounding what we're seeing. And I don't think that the numbers are lying to us.
So let's talk about what we heard from Peter Bukvar, which I thought was really fascinating that Tom brought up, that people are overhiring and companies are scarred by what happened post-pandemic when they fired a lot of people and then had to bring on staff that just was not there. How much is that going to be a persistent theme throughout whatever happens in this next cycle?
We think that labor shortages are here to stay. A lot of it's demographic. You have more people retiring from the labor market than you do young people available to refill those jobs. We also have very strict immigration policies in the U.S. That makes it very difficult to find labor from outside of the country. And still you have many people who are challenged with childcare issues. Many people don't want to work 2 and 3 jobs. That's why they're trying to find higher wage jobs. We think that this is just going to be an issue even beyond what we're thinking is going to be a brief recession in the U.S.
Okay, so what does that mean for how persistent upward pressure on wages is likely to be?
Well, certainly if inflation continues to be elevated and the Fed struggles to get back down to the 2% inflation target, we think that there's probably the potential for a wage price spiral. Already, if you match up the PCE deflator with the ECI, they're both moving together. And that's really a challenge that the Fed is trying to prevent from happening with its actions.
But obviously its actions have a lagged effect. It takes a while for us to see the real impact of it, as evidenced by how strong the payrolls report was on Friday. So can the Fed act quickly enough that they are actually going to be able to lasso that and get that under control? Or are we going to be looking at a situation where this actually does end up eventually out of the Federal Reserve's hands?
Well, I think the Fed is acting as quickly as it can. I mean, other than raising rates every month, certainly at every meeting since March, they've raised interest rates, and I think the Fed's doing what it can. But as you said, monetary policy comes with a lagged effect. First, you're going to see the effects on things like mortgage rates and the housing market, and then consumer spending, and then inflation. And so it's going to take some time, but we feel that the Fed can probably do its job and get things done in terms of bringing down inflation.
Dana, does any measurement of housing rent or ownership get in the way of their plan? I mean, can housing be such a crisis, it's so expensive, so persistent, that it just gets in the way of their best outcomes?
Well, surely housing is a huge driver of inflation right now for consumers in the U.S. And certainly as long as home prices, the valuations of new and existing homes continue to rise, that's going to show up in the OER and in rents with a lag, of course. And so that really does present a challenge for the Fed.
Dana, I got to leave it there. Dana Peterson, thank you so much. Greatly appreciate it with the conference board. Lisa, I featured this last week. To me, it's the single biggest issue. It's not about the haves and the have-nots. It's about both. It's about where do you put your, your bedroom? Where do you put your living room? Where are you going to live? And it's a national crisis.
We saw prices of homes climb substantially. They're starting to cool off, but there's a lag effect for how long it takes for that to trickle out into rents. And the more unaffordable house prices have gotten, especially with mortgage rates where they are, the more people want to rent, which is the reason why they can continue getting pushed up further and further before reaching that breaking point. And you're seeing that not just in places like New York City, but all around the country.
I mean, Kaylee, I'm looking at the bank rate here, and I guess it's come in, but I'm sorry, we were at 4% in February, up to 6%, and we've pulled back mightily to 5.6%. That doesn't get it done.
Yeah, and it's still significantly higher than if you were looking to buy a house 6 months ago. It comes back to the affordability problem. And as we have that conversation with Dana about wages, people demanding higher wages, people aren't earning enough to keep up with inflation, even with the wage gains we are seeing. And at what point, obviously, you're starting to see that showing up in housing data, but what point does that start showing up in everything else? People just not being as tolerant for the higher prices that they're facing.
I'm sorry, it's a round number. The NASDAQ is up 100 points, 13,000. It's not like Dow points. It's not like the Dow Jones Industrial Average.
How much is the Dow up, Tom?
It's up. The Dow is up 141. I mean, I'm sorry. I'm not in it. It's a bull market. This is Bloomberg.
Biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance, it's a Bramo bull market. Lisa Bramo is with us to give us team coverage here with NASDAQ futures now up 0.8%. I'm sorry, Lisa, it's a melt-up. Pharaoh would say, it's a melt-up, Tom.
Is that your European accent? That's your British accent.
That's my British accent,
Oh my
close as I
goodness.
get.
Okay, so you can write in about his Marmite references in British accent. But yes, I would say
it's a melt-up.
It's a melt-up. I would say that this is a persistent increase in terms of valuations despite all the gloom. Mike Wilson, but also Goldman Sachs analysts coming out and saying that profit margins are going to get squeezed. Still, you're seeing the S&P up 0.6%, NASDAQ up 0.8%, even with 2-year yields climbing so significantly and climbing so significantly past the 10-year yield.
Kayla Lines, Joe Weisenthal emails in. He goes, hey, stupid, West Texas under 88. I mean, that gets your attention. 87 is not $88 a barrel.
Absolutely does, especially when you see gas prices coming down in the United States for, 50 days now, Tom? Obviously, that politically helps the Biden administration. The question is, how sustainable is it when we had people telling us earlier that oil is going to go back up to $120 a barrel because supply is still so constrained? That's the question.
Futures up 26. It's always an important conversation with Libby Cantrell, head of public policy strategy at PIMCO. But this morning, after historic legislation, it's really critical as well. We're thrilled Libby Cantrell could join us here at our world headquarters. Libby, I want to cut to the chase. How do you put into process the legislation of thousands of pages?
Well, that's a good question. Fortunately, Washington is quite expert at doing that. Most of bills tend to be hundreds, if not thousands, of pages. But I think that what this sort of underscores how quickly this bill was able to come together to be passed by the Senate, will be passed by the House later this week, and then promptly signed into law, is that many of these ideas, Tom, have actually been percolating in Washington for years. Take the drug pricing in terms of allowing Medicare to negotiate drug prices with pharma. That is a concept that literally has been percolating since I was on the Hill back in 2003. So in some ways, many of these ideas, again, have already been in text. Were able to be put into legislation immediately. The big question, of course, was just to get that unanimity among those 50 senators on the Democratic
side. The question I asked our Jack Fitzpatrick, can the Republicans take it away if they win the House and the Senate?
Can they take it away? It will be very difficult, and I think what you've seen even with the Trump tax cuts is it's very difficult to take things away, to take benefits away, particularly on something like the drug pricing for Medicare. That's something that polls incredibly well. More than 80% of Americans support that provision. Older people tend to vote. So particularly for that, difficult to take away. And then on the climate piece, and as a reminder, $400 billion of tax incentives for production and for consumption on the sort of the clean energy tax front. All of that, pretty difficult to take away as well. And most of those last for 10 years.
And Lisa, I looked at the Medicare-Medicaid combination for federal budget. Thank you, Robert Jameson, for helping out of Washington. And not out of 65 and LBJ, but roughly Nixon, we've gone from 1% of GDP out, really approaching 6% of GDP for those two programs.
I did not know that. That's really fascinating, and a reason why this has been such a big issue. And of course, I looked at the pharmaceutical companies' shares ahead of the open, thinking that they'd be tanking because they were going to get less income from Medicare. They are not, Libby, which raises a question about what the tangible effect on investment will be from this bill. If even, you had David Sowerby on earlier decrying some of the concerns about the taxes on buybacks, share purchases, as well as that minimum corporate tax imposed. Is there a corporate read-through that is not getting priced in, or is this not as significant a move in terms of crimping profits, as some would say?
Yeah, so Lisa, on your point about the pharma companies, they actually got a little bit of a lifeline over the weekend because one of the bigger provisions that was in the bill that would have required that pharmaceutical companies negotiate with private insurers on the pharma prices actually got stripped out of the bill because of some parliamentary mumbo jumbo, didn't qualify for the so-called reconciliation bill. So that's maybe why you're actually seeing a little bit of support in those names this morning. But overall, I don't think we should overstate the impact of this bill. I think invariably there will be winners and losers. Losers like the pharmaceutical industry because some of those provisions obviously still persisted. Technology, some of the companies that have been able to take advantage of this sort of book income corporate tax rate sort of arbitrage will also be losers. And then, big winners, obviously renewables, which are really priced in. So I think sort of the macro impact or even the sector impact has likely been pretty much priced in here. But overall, in sort of my world, the political impact, I don't think has actually been priced in. I think this is a huge boon for Democrats who really needed it, right? The price of gas, Biden's disapproval ratings, the generic ballot, all have been major headwinds for the Democrats going into the midterms. And here they are. Here they're able to go in at sort of the 11th hour and really campaign on the fact that they can govern and that they can get a big piece of their agenda that they campaigned on in 2020 through, which was the climate piece.
So, Libby, what is the market read-through in terms of if the Democrats keep the Senate, if the Democrats don't lose as much of the House, which seems to be the feeling that's increasingly getting speculated upon?
Yeah, so I think, Lisa, the conventional wisdom that the Democrats will lose the House is probably right. If you look at history, right, since World War II, the party in power has lost an average of 25 seats in the House. So just if past is prologue, Democrats face an uphill battle. But the margins there do count. I think our view is that they could lose maybe as little as few as 10 seats or as many as 50 seats, sort of depending on voter enthusiasm and what's actually happening in sort of October and to the buildup of November. And that margin does matter because in the long term, because that means if they lose fewer seats, then they're going to be able to more likely recapture the House in 2024. On the Senate, though, and we've been saying this for a while, it's much more of a jump ball. The Senate tends to not be as much of a national election because, of course, only a third of the Senate seats are up for re-election. Republicans have actually a more difficult map this cycle, and some of the candidates that are running on the Republican ticket in battleground states like Georgia and Pennsylvania, maybe even in Ohio, are sort of less experienced, more green, and as a result, maybe have less of a chance to win. Even when the national mood is really much more supportive for Republicans. So I think bottom line here is the House is likely lost for Democrats, at least at this point, but the margin does matter. The Senate, much more of a jump ball. Lastly, in terms of the sort of the policy implications, though, as long as Republicans take back just one chamber, that means that Biden's legislative agenda for the next 2 years is likely, dead or at least on ice for a bit. There's still some chance of bipartisan legislation around tech and some other areas, but probably on ice. So that really is, for the market's perspective, what people will be really focused on. But again, folks like me are focusing a little bit on the longer term and sort of the read-through for 2024 in particular.
Well, Libby, you mentioned voter enthusiasm a moment ago. I'm wondering if there's a lesson to be learned from Kansas and the abortion vote there, the turnout that we saw. Is there an underestimation of the galvanizing effect that some of the social issues like abortion may actually have on voters approaching the midterm beyond just kind of the macroeconomic environment?
Yeah, again, and this is, again, another piece of good news that the Democrats have had over the last several weeks. Of course, voter turnout in Kansas much higher than expected. That ballot initiative lost by almost 20 points. Now, there are some idiosyncrasies that I think are maybe difficult to extrapolate from Kansas sort of nationally. But I think it is, I think that for Democrats, their big takeaway is that this is a galvanizing issue. Now, one important distinction distinction, of course, is that was a particular issue that was on the ballot versus just, the midterm elections, which are more general, where candidates are on the ballot.
Quickly, and this is completely unfair, but it's unfair Monday here, we have this ginormous legislation. Is this the window for President Biden to say he's a one-term president?
I highly doubt he will do that. Yeah, I mean, theoretically, sure. I think he will not do that, especially before the midterms. But I think, Tom, it's a good point in that he will likely have to decide whether he really is going to run for 2024 shortly thereafter. Remember that in the debates start in June of next year. So we actually need to have a pretty good idea.
Can't we be like the British? Where the hell is Pharaoh? Get Pharaoh back.
He's not going to come back if you make that British accent again.
That old republic.
Lisa, come on. The British, like, they get it done, Sunak, Truss, and all that. And Libby's depressing me with debate. You know, the debate started in June?
Yes. Well, if 2019 were any...
How many people will be on stage? Like, 42 people?
Well, look, I think if President Biden does not win, that we are going to see a very kind of open and potentially kind of messy and raucous primary on the Democratic side, and the same thing on the Republican side.
Last time wasn't raucous.
No, exactly. I think that will be... the last time it was just on one side,
British
right?
Do it so, come on, the British do it so much better.
Well, it's also a parliamentary system, Tom. You know that. I mean, this is different.
I do. It's a what?
A parliamentary system.
Tom knows a lot of things that he likes to do.
I did not know that. Thank you, Elizabeth Cantrell. Greatly appreciate that. So at least I'm learning it's not it's a parliamentary system.
So you want a road trip to London?
I think we need. So I get a civics lesson from Pharaoh.
The parliamentary situation and Marmite.
Let's go to the Marmite here. Let's go to the market. I'm sorry, Lisa. The biggest story today is a negative 44 beeps inversion on the 210. I mean, it's screaming the way it's going towards 50 basis points.
We've just gone straight through Priya Misra's call for 40 basis point inversion, and you've seen that 2-year yield continue to climb and that 10-year yield continue to go lower, at least on a relative basis. We'll be talking about that coming up on the Open with Michael Kushma, Global Fixed Income CIO at Morgan Stanley. We also have a host of other guests, including Stuart Kaiser.
You're leaving now to go to your other property?
Yeah, it's John Farrow's. I'm renting it while he's off in Capri.
Thank you,
Airbnb
Lisa.
being the Open.
Yeah.
Well, you'll be back tomorrow. It'll be wonderful. Kaylee Lines and Tom Keene and Bramo as well. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden and his party finally got the win they've been waiting for. The Senate passed the Democrats' landmark tax, climate and healthcare bill. The House is expected to pass the measure on Friday. It's a slimmed-down version of the $10 trillion plan that progressives had sought more than a year ago. Now the question is whether it can give Democrats a boost going into November's congressional elections. China signaled that military activity around Taiwan was continuing past those drills announced in the wake of House Speaker Nancy Pelosi's visit. The Chinese military says it conducted anti-submarine and naval strike exercises today. The recent maneuvers near Taiwan have been the most provocative in decades. And Russia has told diplomats it's ready to welcome international monitors into a Ukrainian nuclear power plant that came under attack last week. United Nations atomic inspectors have said there's a very real risk of a nuclear disaster at the plant. Ukraine still believes there are around 500 Russian soldiers in and around the site. And the biggest U.S. meat companies getting hit by inflation that's hurting sales of beef and chicken. Tyson Foods reported quarterly earnings that missed estimates. The company says higher prices are leading shoppers to trade down to cheaper cuts and to limit visits to restaurants. And SoftBank CEO Masayoshi Son is promising there will be widespread cost-cutting after a record $23.4 billion loss. The Tokyo-based company lost the vast amount of that money in its Vision Fund investment arm, which marked down the value of holdings such as DoorDash and Coupang. SoftBank has also lost more than $6 billion because of the weaker yen. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online. Bloomberg Green, bringing you the business, data, and innovators fighting climate change. Reinventing climate news on TV, Quick Take, and Bloomberg.com.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Headline inflation will be falling, primarily because energy prices coming down. But core inflation, that really represents how tight the domestic economy is still rising. And don't think we've reached the peak in that.
Ellen Zentner, fascinating with Morgan Stanley, dovetailing the caution of Mike Wilson and her measurement of the American economy, not destroyed, but everyone would pause Friday for a jobs report. Lisa, we haven't talked enough about that right now. I mean, I'm sorry. 500 whatever thousand was a wow. Excuse me, Kaylee. I'm sorry. Kaylee, I'm just frazzled here this morning. Farrell, one-day trip, and I'm just falling apart. Kaylee, 500,000 plus is a wow statistic.
It was. It blew past expectations. You also had wage growth that came in higher than expected, Tom. That is a strong labor market that, in theory, gives the Federal Reserve clearance to be as aggressive as it says it is going to be to get inflation down, making the read we get on Wednesday and CPI, core in particular, all the more crucial. I don't even know why we're here today, Tom, or tomorrow. We should just come in on Wednesday at 8:30.
Well, I think it's been interesting. And again, a little Merger Monday theme going on as
That's
well
true.
as people, CFOs and such, look at a set of smaller transactions. Right now, a bigger transaction, and I mean a larger transaction, has been the amendment. Well, let's stop right now. We've got the president here at Rehoboth after COVID, where he and Dr. Biden are getting on Marine One, and they will go up Delaware Bay, and they will move from Rehoboth up to Dover Air Force Base for a somber trip to Kentucky, all the challenges that they've seen in Kentucky and flooding here. Maybe Senator McConnell there after this important legislation will greet the president. We'll have to see for that as well. The president on Marine One in Delaware. Right now, not on Marine One, but someone looking at the strong dollar that can afford Marine One is Dara Meyer, head of research and FX strategy at HSBC. And I will not mince words. HSBC with absolute leadership on strong dollar and resilient dollar in the last number of years. When does the dollar give it up?
Not yet, not yet. And it's interesting, there's been a few times, hasn't there, where people have tried to call peak inflation, peak economy in the US, and therefore peak dollar. And they got it wrong on Friday. They might get it wrong again this Wednesday around US CPI, but everything we're hearing from the Fed is be patient. We want to see the numbers on inflation. We need them to come down. And so, yeah, I think they're calling it early.
Lisa Cayley's got some important questions here, but what I would really want to focus on is the effect of this resilient dollar on EM. HSBC out of Hong Kong has a huge view of EM. How does EM survive a resilient or even stronger dollar?
This is a really tricky environment for EM because you've got that strong dollar, you've got a Fed tightening, and you've also got a global economic slowdown. A lot of the time in the past, we've seen the Fed tighten into economic strength, not into global economic weakness. So this is a really problematic mix for emerging market currencies.
Yeah.
You can't find a couple of local winners, but as a universe, it's that's a very tricky environment for that.
Lisa Cayley, to me, this is why Damian Sassower is so important right now. I mean, I really can't say enough about it.
Yeah, his work over at Bloomberg Intelligence is definitely crucial coverage at this moment, Tom. Lisa Cayley, I'm enjoying my new name. Dara, when we talk about the dollar, is it so much dollar strength or weakness of everything else that is the backbone of your call?
That's a really good question.
Yeah, well, it feels like it's all about the dollar, doesn't it? Every conversation we have about currencies, with the odd exception, Bank of England creeps in, the ECB creeps in, but we always come back to the Fed, we come back to non-farmers, we come back to US CPI. So to that extent, I think the dollar is at the core of the FX call. The second thing, and I think this is something people are making a mistake about, is the dollar is at the core of the call, but that doesn't mean the US economy of itself is at the core of the call, because we have to think about what's happening to economic growth outside of the US, what's happening to real incomes outside of the US. And it's that global slowdown that is supporting the dollar, despite the fact that the US economy is slowing as well. And that's the mistake dollar bears have been making. They've been saying, hey, the US economy is going to slow, the Fed are going to have to slow, the dollar is going to slow. But the reality is the dollar does well when the global economy is under pressure.
Well, and of course, one of those economies under pressure is really the Eurozone and the UK as well. You mentioned the BOE and the ECB. Realistically, any hikes from those central banks, can they be supportive of the currency if they're hiking into substantial weakness?
Well, answer to the first question is yes. I think we will get more hikes. I think they recognize they have to do something to bring inflation lower. But does that translate in the traditional way to a currency positive? I'd say no, because as you point out, they're doing it into economic weakness. What I actually like about the Bank of England, frankly, though, is I think they've kind of come clean in saying, look, if we want to get inflation lower, a likely side effect of that is an unpleasant one. It's going to be a prolonged recession. Everyone else in G10 is telling us, hey, we're going to navigate inflation lower. We're going to do it with the soft landing. Please don't worry. I mean, maybe that's the right thing to say, but everyone's saying it's a narrow path, but everyone's forecasting they're going to land this narrow path. So I think kudos to Bank of England to my mind for coming clean. It's not going to help sterling, of course,
right?
But I think it sets up expectations perhaps more realistically.
Yeah, at least they're being honest. So we've obviously already seen parity on euro dollar. Do you think realistically we could see it on the cable rate?
I don't think we'll get quite that low. I mean, much as I'd love to, because I'm paid in dollars and I've got kids in the UK, but it's not going to quite play out that generously for me. The dollar is overvalued, or at least it's rich against a number of currencies. Euro, I think we can go sub-parity, 95 cents, without that valuation elastic band being particularly unpleasant. But to talk about parity against cable, that would be a big stretch. I mean, maybe 115, 116 is plausible, but I don't think we'll go a great deal further than that, bar some calamity.
The difference in this conversation is we're freely floating back to the crises of the 90s, except the yuan is not. Is renminbi freely floating within its band, or is it fixed within its band?
It's a teenager, and let me explain. You've got a teenager. the world. But if it misbehaves,
right. When are you leaving?
If they misbehave, they will ground it, and that's what happens. So if you get the currency market to their mind misbehaving, then they massage, then they nudge, and then they ground the currency. I would say for the most part, renminbi of late has been kind of left to its own devices, and I think it's been behaving, and it's been important because it has been a somewhat helpful anchor in the Asia context, at least. But I think maybe we expect a little bit more of the Chinese economy. Do you remember 3 months ago, a lot of talk about a second half acceleration, policy-led, and that's kind of...
Is it just delayed? I mean, where do you and HSBC, very quickly here, where do you and HSBC frame where China not gets escape velocity, but at least moves the vector around on GDP growth?
Well, I think it's happening in a small way already, but it's less kind of big scale than people might have anticipated. It's very targeted easing, and so we're not kind of getting that big showpiece of, right, okay, here's the big stimulus. And the problem, of course, we're not getting that, but we are getting this continual erosion of growth expectations elsewhere in the globe. So net, everything's kind of feels like it's tracking lower.
Me, Kaylee, Lisa, John, I mean, the Mandarin, I mean, in Hong Kong with the HSBC team, this could work, right? In Hong Kong?
I think, look, that could be the dream team. Could be the dream team.
Steve Major, Dara Mayer, and the rest here at the Mandarin in Hong Kong. Kaylee, I think it works.
All right, road trip.
Captain's Bar. Here we come.
Got that right. Dara Mayer, thank you so much. With HSBC, Futures Advance, up 27. Good morning.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a gray zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
From New York City for our viewers worldwide, I'm Lisa Abramovic in for Jonathan Farrow. This market wants to rally on this merger Monday, led by the Nasdaq up 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Farrow.
We begin with the big issue, the next big data point.
We get CPI.
Wednesday CPI.
Another CPI reading coming out this week.
Right.
With this jobs report and the inflation number,
it's really clear that they are on a path to continue to raise those rates.
what Chair Powell told us is, well, he's data dependent.
Certainly 75 basis points will be on the table.
Look, the labor market right now is very strong. Inflation is very high.
The Fed needs to do more here.
The Fed needs to do more work. I'm just a little bit suspicious about how good the job data was on Friday.
It's a little bit puzzling.
CPI is more impactful in the short term to the markets.
The inflation of 9% CPI.
The Federal Reserve still has its work cut out for them.
They're going to have to go even more.
Joining us now is Morgan Stanley's Michael Kushba and Woody Caesar of Credit Sites. Michael, I want to start with you. How much will this CPI report that we get on Wednesday dictate the tone of what you project to happen going forward?
I think it's very important. We've been waiting a long time for inflation to peak, to come down. People thought, markets thought on the springtime it may happen. It hasn't happened. Commodity prices, shelter prices, wage growth have all been keep surprising to the upside. So I think it's very important to, at a minimum, to have headline CPI peak. But more important than that is to have that core CPI start falling on a month-to-month basis.
What's your view, Whitney? How much is it going to actually shape what you're looking at? How important is the CPI print?
Well, Lisa, good morning. Thank you very much. I do agree with Michael that the CPI print is quite important, especially because the Fed has told the market that they are going to be data dependent, which means that they are specifically looking at CPI and other data points as well. But I think that the line items are really going to matter. We all know that headline inflation is probably going to decelerate on a month-over-month basis because we've seen a pretty nice retracement in some of the energy commodity prices. But when it comes to core and services, that I think is what is really going to move the needle for the markets and investors, as we need to see those components of CPI really start to slow down.
And Michael, you mentioned that you need to see the inflation start to ease off, but there's a question about how much in order to trigger some sort of response from the Fed. Goldman's Jan Hatzius said that the bar would be very high for a policy pivot and rate cuts, saying the hurdle for cuts in 2023 is high. If I look at market pricing, the market was obviously pricing some pretty significant cuts, but I think that probably would require an even weaker growth environment than what we have in our forecast. We've heard this from a number of different people. Michael, do you agree? Is that really what you're looking at, is perhaps an over-ambitious market with how quickly the Fed will reverse course?
I think that's very true. I think what we're talking about is an amelioration, a slowdown in the month-on-month paces to slow down the pace of rate hikes, not to have them stop or turn around and turn a rate in terms of rate cuts next year. We're talking about whether or not the Fed raises 50 basis points, 75 basis points, or an out-of-the-box number, 100 basis points in September. If this number turns out, suppose it goes up rather than coming down at the margin as the market forecasts, that could change the big-time expectations with regard to how much it tightens this year. Instead of only going to 3.25, 3.5, maybe the Fed needs to go to 4 if this number doesn't come down. So I think the risk is how much higher they go, not if they come down or not.
Whitney, do you agree? And if that's the case, what would be the ramifications, not only for the rates market, but also for credit?
So I think that the credit market is very much focused on liquidity within the broader system and whether there is an ability to raise new capital, which as of last week, there was definitely a strong ability still for investment grade and high yield companies to come to market. I do think that one thing that we need to keep in mind is the Fed and Chair Powell have really emphasized the kind of delay in the tightening of policy and then the actual reaction in the broader economy. So I do think that we need to keep in mind that the Fed is going to be data dependent, but also focusing on what is the lag effect of rate hiking. And so I think one of the reasons that we're not necessarily expecting to see a 4% Fed funds rate by the end of the year is because we do think there is going to be some tolerance for slowing down the pace of rate hikes, so long as there's some evidence that inflation is starting to come down. And that would leave us biased to expect that the Fed is going to kind of slow down rate hikes and then try to hold rates steady for an extended period of time to see how the economy reacts.
Well, this is parsing into some of the data points the Fed says that they are depending on, and we get a lot of them this week. A host of economic data, Fed speak as well ahead of that Jackson Hole meeting, and we are looking also for the latest read, not only on inflation for CPI, but also at the University of Michigan Sentiment Survey on Friday. For more, Yelena Shulyetyeva of Bloomberg Economics joins us. Yelena, how important is the core figure going to be in this CPI report? Because the headline is expected to come down. How important is it to see that the core level does come down to a significant degree for people to think perhaps that the Fed pivot is still in play?
It will be crucial, and I think that's what will drive inflation in the next few months. So if you look at the headline, as you mentioned, everybody seems to agree that the headline is going to come down, and in fact, it's at a face value, it's consistent with 2% inflation target. What really matters is core. How shelter prices going to behave going forward, and other components. I think it's really important that wage pressures don't show any signs of decelerating. The latest labor market report on Friday showed that average hourly earnings just failed to decelerate. They keep running hot, and other data, including ECI, including Atlanta Fed wage tracker, they all show wages are growing and at a significant pace.
Yelena, what's your projection for how quickly the pace of CPI could come down? I mean, this is something that Michael had mentioned, and I want to get back to him on that in just a moment. But first, Yelena, I would love to get your sense of if we get to 8.8%, let's say, for headline CPI, how quickly could we get back to 4%? And then how quickly can we get back down to that 2% target of the Fed?
Well, not next year. I think we are at around 8% for CPI, just slightly lower on core by the end of this year. And we see very slow deceleration going into next year. So I think the Fed will hike and will hike aggressively. And actually, Bloomberg Economics is probably the highest in terms of Fed funds for the terminal rate.
Thank you so much, Yelena Shulyetyeva, for joining us today. Michael Kushma and Winnie Caesar are still with us. Michael, what's your view on this, considering that we do see this idea, even if you have a decline in inflation, how big of a decline do you have to get before the idea of pausing or slowing those rate hikes?
Well, first of all, we take into account that the Fed has, over the course of the last 12 months, have keep ratcheting up their inflation forecast. So they had targets for the end of 2022, end of 2023, and those numbers keep getting pushed higher because inflation has not shown signs of stabilizing, let alone come down. So first thing we have to see is stop going up, month on month, and stop increasing month on month and start going down month on month. Inflation is persistent. It's going to be difficult to see a sudden drop in core CPI anytime soon. So I think what we need to see is on a distinct downward trajectory, such that by the fourth quarter, inside the fourth quarter, we see month on month changes which are annualized, which have a minimum a 4 handle on it. That probably would be good enough, given lagged effects of monetary policy and the slow trends in inflation, to potentially make the Fed comfortable that policy now is tight enough to wait and see, become very data dependent to see how much inflation will continue to decelerate into 2023. But we start to have to see those numbers come down. So even in this month's forecast, 0.5% annualized is still 6% core CPI. That number has to get to a 4 annualized handle by the end of the year, sometime early in the fourth quarter, in order for, I think, the Fed to become more comfortable that inflation is on this persistent downward trajectory to meet their end of 2023 target.
And given that this is the debate when it comes to Fedland, the debate in markets are whether companies and stock traders and credit traders are accurately reflecting the risk embedded in a scenario of such a significant slowdown to bring that inflation rate to the Fed's target. I'm looking right now at NVIDIA with a projection and a preliminary second quarter revenue projection that comes in below expectations. So shares are tanking. They're at one point down as much as 8% ahead of the market open. Winnie, from a credit perspective, does it make sense to you that we just saw the biggest rally in high yield bonds going back to 2011 and that they have continued into the month of August?
So I would say the magnitude of the rally has been quite surprising to us, but the direction of the rally is something that we were expecting. High yield and really broader corporate America, including investment grade, came into the slowdown just in really good kind of rock solid shape from a balance sheet perspective. It's no surprise that when you've pulled forward a lot of growth and also given issuers ultra low borrowing costs, that your starting point is going to be quite solid. Now, I do think that high yield relative to investment grade might be a little stretched at this point, but we're also looking at the changes in the distressed market, which has also been quite meaningful since the end of last quarter, where we're seeing far fewer distressed companies, especially in the world of triple Cs, which has pretty positive implications for forward default rates. And a lot of the liquidity conditions in the market are very much kind of self-fulfilling. If investors expect defaults, then they're going to kind of cut off liquidity to those lower rated issuers. And if they're not expecting defaults, if they're expecting that things are going to be a little bit more stable, then they're going to continue to allow for kind of the life ropes that are needed to get through some of these more transitional times.
Michael, your final word on credit?
I think broadly, similarly, that the high yield market this year has benefited by a tremendous technical advantage, a very limited supply. New issue of bonds is running at record lows after record highs the previous couple of years. So high yield companies have done a really good job of shoring up their balance sheets, borrowing money when yields were low, and now being able to ride through this sell-off without having to raise new funds at these much higher yield levels. So I think that technical advantage with ongoing strong cash flow, fund investors having coupon payments that need to be reinvested is a very strong technical dynamic. But on the other hand, the economy has slowed and is likely to stay on a slow trajectory going forward. There's a meaningful probability of recession next year. We think it's still going to be relatively mild, so default rates will not increase substantially. That longer term high yield looks okay, but in the near term, given the rally we've seen in July, we do think it's a little stretched versus higher quality bonds.
All right, Michael Kushma, Winnie Caesar, both of you are sticking with us. Right now, we want to get some of the stocks moving ahead of the opening bell. Abby Doolittle here with us. Abby.
Hey, Lisa. Well, let's start out with what is working, because we do, of course, have the futures higher. And one stock that is popping is Global Blood Therapeutics. This, of course, is Pfizer's buying the firm for $5.5 billion for its sickle cell therapy. Pfizer has made it very clear that it will be investing many of those COVID profits into new therapies. We have First Solar also higher, up about 6%. Clean energy generally higher as that Inflation Reduction Act passed. A big portion of it, of course, for clean energy. And JP Morgan has upgraded First Solar to overweight from neutral. So 2 notches. The analyst saying there, this is the biggest move for climate in terms of money being spent by the government. To the downside, though, Palantir, it, of course, is tumbling as the data firm cuts both its annual revenue and profit outlook. Mainly government is the revenue breakdown, but it's also commercial slice that they've been trying to grow. But it looks like maybe it's being seen as a nice to have as opposed to a need to have. And speaking of, Lisa, you were just talking about that pre-announcement from NVIDIA. There it is, down 7.3%. They have pre-announced to the downside for revenues, and pretty significantly, the estimate was for $8.12 billion. They are saying that it will come in at $6.7 billion. They report on August 24th. Not a great sign for that big chip maker. And of course, a lot of graphics, data. They've been trying to go into cars. What does this say about the U.S. economy?
Abigail, thank you so much. Coming up, Senate Democrats giving President Biden's agenda a boost.
We had many bumps in the road, many times when it looked like it would never happen, but we never gave up. And here we are. We got it done.
That conversation coming up next. We do see a rally ahead of the open here, climbing that wall of worry. Those yields headed a little bit lower, particularly on the long end yield curve, highly inverted. This is Bloomberg.
record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online. Bloomberg Green, bringing you the business, data, and innovators fighting climate change. Reinventing climate news on TV, Quick Take, and Bloomberg.com.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. Prepares for the latest read on inflation.
We're all pumped for a happy CPI day.
Will headline inflation ease as expected?
If you get something that comes in much lighter, this rally that we're seeing, we think it will continue.
Instant reaction on Bloomberg Surveillance.
That headline CPI figure.
That's going to be a scary number.
That is an upside surprise.
And what it means for the Fed.
The Fed is not about to pivot.
Powell is willing to push this as far as needed.
Inflation in Focus, Wednesday on Bloomberg.
At last, we've arrived, and we are elated and really confident that the Inflation Reduction Act will endure as one of the defining feats of the 21st century. Our bill reduces inflation, lowers costs, creates millions of manufacturing jobs, enhances our energy security.
Senate Democrats bringing President Biden one step closer to legislative victory, passing the tax and climate bill key to his economic agenda ahead of those November elections. GOP Senator Pat Toomey criticizing the bill, saying, quote, Democrats insist on pouring fuel on the fire with another partisan tax and spending spree that will only further exacerbate a recession we're already likely in. For more, let's bring in Bloomberg's very own Emily Wilkins from Washington, D.C. Emily, the vote-a-rama happened. I'm sure everybody slept on the floor of the Capitol as you tried to track the votes. What is this going to do? How big of a deal is this legislation that the Senate passed and is now on track to go to the House?
So it's a huge win for President Biden. It's a huge win for Senate Democrats. And the House is expected to be able to move it. They're going to come back and have that vote this Friday. I think the real trick here is going to be in terms of what impact it's going to have. It certainly will have an impact on things like renewable energy, an impact on lowering certain drug prices through Medicare. At the same point, I think there's a big question of exactly what kind of impact this is going to have on the November elections, which will be interesting to see. Certainly, this is a new tool in the Democrats' toolkit, something they can campaign on, something they can talk about. At the same point, inflation is still a #1 concern for a lot of Americans, and it's going to be hard for them to say, hey, we passed this bill that's going to eventually implement all these things. This isn't something Americans are going to feel right away, and so this doesn't necessarily mean that Democrats are going to win in November just because they finally are now passing the signature piece of Biden's agenda.
From an analytical point of view, Emily, what's going to be the ramifications from the 1% tax on share buybacks, on the 15% minimum tax that's going to be imposed on specific companies that typically have gotten away with finding loopholes and other ways around some of the minimums?
I mean, this is something that Democrats are really going to be able to tout. They've shown a lot of polling showing that folks don't think that a lot of companies are paying their fair share. At the same point, it does really apply to sort of the larger, bigger companies. They're trying to keep impacts away from small and medium-sized businesses. And so this is something that Democrats are going to be able to, again, continue to tout as a victory on their behalf to their voters. It's also going to help pay for this overall legislation. Remember, a big thing that Senator Joe Manchin was pushing for was for this bill to reduce the overall federal deficit, which it does thanks to provisions like the $15 minimum corporate tax rate, as well as the 1% tax on stock buybacks.
Meanwhile, Emily Wilkins, thank you so much down in Washington, D.C. for that. Michael Kushba and Winnie Caesar back with us. Michael, from your perspective, another component of this bill was to reduce the deficit to some degree and try to shore up the national profile. How much does that actually have a tangible market read-through on the fixed income side, which does hinge on the creditworthiness of the United States?
Longer term, it's important because longer term, the U.S. fiscal situation is not really sustainable. Running deficits, 5-6% of GDP when things are relatively good. What happens when the next recession comes or big recession comes, which will eventually happen at some point in the next several years? The deficit grows. In addition to that, the era of very, very low, ultra low interest rates seems over as well. So the interest expense on the national debt grows as a percentage of federal expenditures, which unless other taxes are raised, that will eat away in program spending across the board. And since there's a lot of mandated spending, legally mandated spending, that affects discretionary spending. So the ability to bring down deficits and slow the growth of national debt when times are really good is important longer term. Otherwise, we will run into a situation down the road. Again, down the road, don't know exactly when, where there will be a premium, some kind of extra premium put on long-dated U.S. treasuries.
And Winnie, from a credit perspective, there's an analog here that's pretty direct, which is that you've seen companies refinance and push out maturities really far into the distance during the post-pandemic debt boom that we saw fueled by Fed money. How much do we see companies actually paying down their debt more significantly in anticipation of higher rates to come, both on the interest rate side as well as credit?
So we haven't seen a lot of outright debt pay down quite yet. And I think that it would take a pretty material and sustainable move higher in yields for corporate America to say, okay, we actually need to, in aggregate, reduce our debt loads across the board. Now, what we have seen is some nice deleveraging from kind of the peak pandemic prints because we've seen earnings growth come back online. And when we look at some of the other important credit ratios, things like interest coverage or the ability to service debt, that is still at very, very elevated levels. And so in order for corporate America to say, okay, actually, we need to start to change our behavior significantly, you need to start to see those coverage ratios come down from a combination of higher borrowing costs or lower earnings, or alternatively start to see the ratings agencies get really proactive in terms of downgrades, especially from triple Bs to double Bs.
So Winnie, do you foresee a problem if rates go to that 4%, just quickly?
So if rates go to 4%, I don't actually see that as a particular problem, given that spreads are still relatively intact. It would all depend on kind of the broader economic outlook and what was going on in the background, but we would actually need to see a pretty significant move higher in rates for a lot of balance sheets to be unsustainable in nature. Of course, at the margin, there would be some stresses, but in aggregate, that wouldn't necessarily be a really kind of critical downgrade moment across the broader market.
Winnie Caesar, Michael Kushba, to thank both of you, thank you so much for being with us. Just to give you a sense, President Biden currently is speaking. He is on his way from Rehoboth, Delaware, on to Kentucky to visit some of the victims of the recent flooding there. He did give some comments as he now heads onto the plane. We will track that coming up, the morning calls, and later, Stuart Kaiser of UBS seeing recession risks fully priced into markets. That conversation still ahead. We are seeing a rally ahead of the open here as the wall of worry dissipates against the potential opportunities that gloom giving way, although perhaps not as much of a gain as it was earlier. NASDAQ up 36. This is Bloomberg.
cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize us as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and so it's so uncertain. But it has the potential to completely upend everything.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Canaccord raising its price target on Tesla to $881, expecting EV momentum to remain secure. Next up, Pivotal Research cutting Roku to sell with a $60 price target, citing valuation concerns. And then finally, JP Morgan downgrading Carvana to underweight, seeing unattractive risk reward with limited growth visibility. Coming up, UBS's Stuart Kaiser. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
This is Countdown to the open. I'm Lisa Abramovic in for Jonathan Farrow. Moments away from the start of trading, we are seeing a bit of the momentum lose steam, just a touch ahead here with 0.3% gain for the NASDAQ 100. How much of that is led by NVIDIA, which is tanking? Russell 2000 up 0.7%, S&P up 0.5%, a bid into treasuries, and that has been a theme, which is fascinating, especially in light of the CPI that came out, that's going to come out on Wednesday. We are seeing a bid in, particularly to the long end, down to 2.78%. A bit of dollar weakness across the board. The euro 101.98, and crude steadily below $90 a barrel, 88.26. Just shocking to see how much that has come off. Joining us now with a look at the stocks moving at the opening bell, here's Katie Greifeld. Katie.
Lisa, I've got 4 gainers for you today. Let's start with Signify Health. It is surging this morning after a 16% rally last week. That's on reports that CVS is preparing a bid for the company. The logic there is that Signify would help expand the CVS home health unit. You can see Signify shares up almost 16%. Plug Power, too, rising. It's a big morning, really, for the clean tech sector after the Senate passed the Tax, Climate, and Drugs bill last night. Democrats calling it the largest U.S. investment ever in fighting climate change. That's putting a bid under the likes of Plug Power, a hydrogen and fuel cell company, and Tesla, too, leading the rally in EVs on the back of this bill, which extends a $7,500 per vehicle tax credit. Finally, Bed Bath & Beyond rising for a 9th straight day, including Friday's 33% surge. The fundamental reason might be that it might sell debt to the PE market. But Lisa, we know it's seeing heavy retail interest, as you can see in today's 40% rally already.
Yeah, I was looking at the price action and thinking, did anything really happen? Katie Greifeld, thank you so much. Stocks extending their climb from June lows. The team over at Nomura calling it, quote, an angst-ridden pain trade, leading to an increasingly unstoppable FOMO-type behavior. For more, let's bring in Abigail Doolittle of Bloomberg. Abby.
Well, Lisa, it is really interesting that in this year of so many declines, the bear market, that we could now be talking about FOMO, but that's exactly right. Because, of course, remember July for the S&P 500 up more than 9%, the most since November of 2020. Combination of less bad earnings, the Fed hiking 75 basis points instead of 100. That really has stirred the animal spirits on this idea of maybe a new Fed put or Fed pivot, depending on whether or not you think that. So take a look at these sectors just roaring higher over the last month. Discretionary, infotechs, those are basically the mega cap tech sectors. But you also have industrials and utilities rounding it out. So a very healthy, broad-based rally. But it's interesting because a lot of investors are actually missing out on this, not surprisingly, because of this year's bear market, that downtrend still in place. If we take a look at the CFTC positioning, most recently we have the shorts, the most shorts going all the way back to, let's call it 2015, 2016. So again, a lot of folks are actually missing out on this rally, including some of the institutional money. And then finally, Lisa, if we take a look at options, it's interesting because there's some mixed messages here. Now, the VIX seems to be dropping out of a year-long uptrend. That could suggest that more gains are ahead. On the other hand, the skew index, which a lot of traders and investors don't like because of its unpredictability, but over the last couple of years, it's been more predictable. It's long out of the money puts. It is creeping higher. It tends to be very early. So you put those two together, it may suggest that this rally could have legs over the next couple of weeks or even months. But watch that skew index. If it goes super high, it could suggest that maybe that downtrend will remain in place.
The future is clear as mud. Abigail, thank you so much. Meanwhile, Wall Street profit warnings piling up. Morgan Stanley's Mike Wilson put out a great note over the weekend, expecting higher input prices to dent profit margins. Goldman's David Kostin echoing that view, looking for net margins to fall by 25 basis points in 2023, with a contraction in every sector. Bloomberg's Kaylee Lyons joining us now for more. Kaylee.
Well, Lisa, if you look backward at earnings for the second quarter, they really haven't been so bad. On average, earnings are up about 8.7%. They're beating expectations by about 4.3%, and that has helped lend a boost to this equity market. The S&P up 9.4% over the course of earnings season since JP Morgan reported. That's actually the best start to an earnings season going all the way back to 1997. We are talking 25 years. But Morgan Stanley and Goldman Sachs obviously don't think that rally is going to last because earnings just aren't going to be as resilient looking forward. Both of them, as you said, expecting profit margins to contract next year due to those price pressures. We'll, of course, get a read on that later on this week with the producer price inflation, which is a critical indicator for profit margins, while consumer price inflation obviously is critical for the Federal Reserve. But that is really the gist of it here, that they are facing higher input costs. They're not going to have as much success passing them on as demand starts to wane, and that's going to create a problem for profits. Of course, Goldman saying that there will be a contraction in every sector. He thinks it will be led by materials, energy, and healthcare. But in another sector, technology, you've already started to see expectations being lowered for this year. Now just 11.2% profit growth seen for 2022. That's down from the near 13% expected just at the beginning of July. So the downward revisions have started, Lisa, but if you believe the bears out there, there's still a long way to go.
Kaylee Lyons, thank you. One person who's been tracking all of the beats is Stuart Kaiser, who has been staying more optimistic. Stuart Kaiser of UBS, he's written, quote, "We see strong growth data is good for risk assets as they trim recession tail risks and continue to see a high bar for large cuts to earnings estimates given the positive nominal U.S. growth." Stuart, I am so happy to say, is in studio with us, sitting right next to me here. Stuart, I'd love to get your sense of just how much you can fight the negativity that you're hearing across Wall Street, whether it's Morgan Stanley or Goldman Sachs, and say, you guys are wrong. Things are going to hang in. And can't you just tell what we've seen? What gives you that confidence?
I think, a big part of it is positioning that Abby just touched on, I think, in particular, is retail investors have started to put money into markets. Buybacks are picking up considerably. And institutional investor positioning is just not there. And I think that speaks to how low expectations were. And the fact that data's coming in better than expectations, I think, is starting to pull people in a bit. If you look at the bear case to earnings, a lot of people have been, talking about 15% negative revisions to forward S&P estimates. Those have been revised down 2% during 2Q earnings. So I think just the negativity that was priced in just isn't realizing itself yet. And, from our perspective, that gives you a little bit more space for the market to push higher because we don't expect inflation to be a negative outcome this month. Expectations are low, positioning is low, and we think you have some room here. Are we going to rally through year end? Probably not, but we definitely think, through the month of August, feeling pretty good.
So is it coherent to see a yield curve that is so deeply inverted? We are seeing the most inversion going back to the year 2000. Is it coherent to see enough weakness in the market that the Fed pivots with this idea that earnings will remain resilient?
Yeah, I think this is the ultimate trade-off between inflation and growth, right? And the fact is, right now, the Fed is prioritizing inflation risks, and that's calmed the market down. It's got inflation expectations, market-based inflation expectations lower. The natural knock-on is that should have a negative impact on growth, right? So the Fed is trying to balance these two things, and our view is because we've seen strong growth data recently, that gives the Fed a little more space and a little more wiggle room to keep that inflation tail risk, at bay, because the growth data hasn't slowed meaningfully. I guess the way we put this is you'd rather have one tail risk than two. And right now they have one tail risk, which is inflation they're dealing with. As long as that growth data remains solid and the employment data remains solid, we consider that a net positive for markets. I know that's a little bit out of consensus, but that's kind of where we sit.
So what about consumer discretionary? And the reason why I point to this is partly because this is John Farrow's property and he has railed against this rally and he said it doesn't make sense. Does it make sense to you, given that if there is some sort of weakening enough to give the Fed confidence to back away, that would be really negative for consumer discretionary?
I think it'd be negative for consumer discretionary to the extent that the labor market comes under real pressure. But I think there's two aspects to this. There's how is the data coming in and what were the expectations, right? The data recently, obviously the jobs report was a little unique, but generally speaking, the data hasn't been home run level data. It's just that expectations were so incredibly low, right? And that's what's gotten the market to rally. I think, what John's communicating and what I think a lot of the other strategists are is that the Fed needs to cause a recession to deal with inflation. I don't necessarily think that's the case, number one. And number two, there's a timing aspect to this. If that recession is 18, 24 months in the future, the market's not going to trade it yet, right? What the market is trading right now is inflation under control, and the very negative expectations we had are not being realized within kind of our investment window.
Okay, so let's go to the CPI report then on Wednesday, and then PPI on Thursday, giving that sense of that margin compression that you heard Morgan Stanley, Mike Wilson over there speak about. How quickly do you have to see it come down to still confirm your belief versus question it and say, wait a second, the Fed might have to go a bit further?
Yeah, look, I mean, inflation is going to decelerate meaningfully month on month. You have headline estimates somewhere between 10 and 20 basis points. You have core estimates somewhere probably between 40 and 50, which would be significant deceleration from last month. And for that reason, we don't think it's as big a negative event this month as it has been. But to your point, those levels are still unsustainable going forward, right? So we need to see not only those levels print this month, but I think we need them to, consistently step down in coming months. so that the Fed is then comfortable that they can back off the accelerator a little bit. I mean, look, the Fed faced a very tricky inflation tail risk, and they've been very aggressive in terms of front-loading hikes to deal with that. The markets responded positively. They've taken down market-based inflation expectations. Now we're in kind of the prove it window, right? We need to actually see the data come in so that things can ease up a bit.
What will the leadership be for the next 6 months?
The next 6 months is a little much. I think,
for
2 days. I mean, we're still in the large cap tech and quality bandwagon right now. And the logic here is because of the policy stance. The Fed is prioritizing inflation risk, which have been the strongest headwind for tech, at the expense of growth risks. In a decelerating growth environment, if you believe that's what we're in, well, then you want to be in companies with stable, defensible earnings, strong balance sheet, and high-quality companies, which we think puts you in things like NASDAQ relative to small cap. So at the highest level, you're sort of long NASDAQ, short small cap for the next 1 to 3 months.
What keeps you up at night then?
Well, I mean, I think, look, what keeps us up at night is a lot of the data outside of non-farm payrolls hasn't looked as good. So the non-farm payroll piece is the one bright spot in economic growth. And if you look across the ocean, European data looks pretty horrible. So this isn't only a U.S. issue, right? You have outside of payrolls, the U.S. economy appears to be slowing. Outside of the U.S., we're also seeing meaningful slowing. So it could be that the non-farm payrolls and the employment in the U.S. is giving us a bit of a false signal about the strength of the U.S. economy. And if that's the case, then a lot of these hard landing outcomes get drawn forward a bit.
Okay, this is actually a really fascinating point, and it possibly is the reason why we're seeing more gains today, right? Because people are looking at that non-farm payrolls from Friday and saying, look, this is actually really strong. And so that's good. If you're only dealing with inflation, we can deal with that to that point, right? Back in 2021, seems like a long time ago, we got data that was revised upward, right, where we had a better than expected labor market, and that completely changed the profile of the markets as well as how people were projecting the economy. What happens if we get a redux of that? How significant of a change would that mean for you?
If the data was revised up or down?
Down.
Significantly. That'd be a major change, right? Because then I think what you're saying is this growth risk is A, larger, and B, closer than we thought it might have been. And in that case, then yeah, I think you start to get in a situation where the Fed is in a lot of trouble because they still need to keep inflation anchored, but now they have both the political and the economic pressure from weakening growth. And I think that's a very dangerous risk for the markets because, like, in our view, almost the worst case outcome is if the Fed gets scared off of rate hikes because growth is decelerating so much. I think that's actually the worst case because what you're going to do is reintroduce inflation risk because they back off of the rate hikes, but now you've added growth risk. So now you're in that two-tail scenario, and I think that's exactly what they want to avoid.
All right, well, we're going to stick with this, so Stuart Kaiser, don't go anywhere. Coming up, we're going to talk about China ramping up military activity near Taiwan.
I'm not worried, but I'm concerned that they're moving as much as they are. But I don't think they're going to do anything more. Right?
You know the live move of the speaker to go to Taiwan?
That was her decision.
Speaker Pelosi's visit continuing to weigh on U.S.-China tensions. That conversation still ahead. We are seeing that rally in markets, perhaps on that jobs report that we got on Friday showing more strength in the labor market than many people thought. From New York, this is Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
You're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
When big tech reports earnings,
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority.
But I'm concerned that they're moving as much as they are. But I don't think they're going to do anything more. That was her decision.
China ramping up military activity near Taiwan in the wake of Speaker Pelosi's visit, extending some of the sorties over that region. This coming as Secretary Blinken travels to the Philippines to reaffirm its alliance amid escalating tensions.
Our relationship is quite extraordinary because it is really founded in friendship. It's forged as well in partnership, and it's strengthened by the fact that it's an alliance as well. The people ties between us are almost unique, and it's something that we tremendously value.
Bloomberg's Joe Matthew joining us now from Washington, D.C. Joe, how significant are the sorties that China's been doing, some of the military operations and practice runs around Taiwan?
Well, they're very significant in that we haven't seen this level of incursion, if I can use that word, to date. Obviously, China's working hard to intimidate Taiwan, and it is making some others in the region a bit uncomfortable. Nothing makes friends like a common foe here, and that's why we saw Secretary Blinken in the Philippines. He's the first cabinet secretary to visit, and President Biden has invited the relatively new president, Ferdinand Marcos Jr., to the White House, although nothing has been scheduled on that yet. But I would expect to see a lot more language like this, not only touring through the region on behalf of the Secretary of State, but language here in the United States that seeks to temper what China is up to in Taiwan.
Meanwhile, Joe, how much is the U.S. trying to build up its potential response to an invasion by China in the mainland into Taiwan?
Well, my goodness, that's not something that is expected to happen anytime soon, just to be clear. But look, we're prepared for a lot of various scenarios. The question is, would we in fact step up militarily if Taiwan were attacked? President Biden has said so, and the White House has attempted to clarify those remarks so as to not suggest some change in policy. But after what we've seen over the past week here, during and following Nancy Pelosi's visit, to see Taiwan essentially surrounded is changing some minds here, or at least creating a new conversation here in Washington about what exactly the U.S. would do, whether it's now or 10 years from now. And I think we do have some time to figure that out. But in the meantime, it's about diplomacy. It's about going to places like the Philippines, where we have a mutual defense treaty dating back to the 1950s, going to Japan and other parties in the region that the U.S. is trying to, consolidate that diplomatic power to influence Beijing.
Joe, thank you so much. China's trade surplus also hitting another record in July. This came out over the weekend. This is the country's COVID-0 policy continues to weigh on domestic demand. Damian Sassower of Bloomberg Intelligence joining us now. These numbers were confusing to some. They came in much better than expected in terms of exports versus the imports. What do you make of this? Is this a sign of the lack of imports, or is it a sign of something else in terms of the nature of the exports?
Well, Lisa, it has to do with the price effect. I mean, half of the move in terms of China having this record trade surplus is due to the move in commodity prices. And so, look, beneath the surface, on the export side of the ledger, this has got to be about auto, steel, and textiles. And specifically, let's focus on autos. I mean, Great Wall and Geely, China's two largest auto manufacturers, have doubled their market share in Russia. Exports to Russia were up 22% year over year. You can see China filling that gap, and you can see them reaping the benefits of it, Lisa. And I think that's where some of the focus needs to lie here.
All right, Damian Sassower, thank you so much. We're going to have more on that coming up. Stuart Kaiser is still with us. And Stuart, I got to say, some of the developments over in China have been some of the biggest wild cards. How much do you view what's going on in terms of how much oil prices have come down? Is really the lack of demand from an economy still shut down in so many places?
I think that has a lot to do with it. I mean, oil's been a really interesting test case this year where the underlying fundamentals, if you talk to an energy expert, sound phenomenal, but the sort of tidal wave of macro global economic slowing has just sort of washed that away. And right, I think you could draw a parallel to even home building. If you talk to a lot of home builders analysts, they'll tell you how good, single stock fundamentals are, and the macro is just sort of washed over it. So I think a lot of what you're seeing in China in oil is frankly the market pricing slower China, but also slower U.S. and slower Europe demand.
The first 6 months of 2022 were all about commodities as the main hedge against inflation. Those shares, whether it was copper, whether it was coal, or whether it was oil, all did phenomenally well. Is this going into reverse? Would you sell into this to gain the gains that you've already gotten, lock those gains in, and move to the next phase of the cycle, which is perhaps a little bit more of a downdraft?
We've been recommending hedging oil outperformance or energy share outperformance for the last couple of months, and I think that makes a lot of sense going through the summer, given the recession risks that are out there. But honestly, it's hard to imagine in September and October, ahead of heating season in the U.S. and Europe, oil remaining under pressure. So I think from our perspective, it's more of a tactical hedge than it is, kind of stepping away from the commodity complex. Obviously, if you have a hard landing outcome, then that changes things. But it's really hard to imagine going into European heating season, doing that.
There's a more sensitive question, and it's one that I keep thinking about, and I was speaking a lot about with different people over the weekend, which is the idea of companies in the United States making goods and using China as the factory to the world. And there have been a number of surveys showing that companies that announce that they are reshoring or onshoring production that previously was was done in China, are being rewarded. How do you sort of look at this in your portfolio as you parse through this data?
We're not looking at that specifically. What I would say is, even a lot of our COVID tests are being made in China. So this is sort of a, highly political charge issue. My view on that would be, if onshoring is positive politically, I think that's probably good for companies. The fact is, though, that does increase production costs at a time when inflation and the consumer wallet is under so much pressure. I think you're going to have, folks looking at that as more of a short-term phenomenon as opposed to something that's long-lasting. I mean, if a consumer is really under price pressure, their ability to trade up, simply for made in America reasons, may be sort of time dependent.
In other words, this is something that loses clout very quickly when it comes to how much people are paying. Just on a broader issue, though, you were talking about Europe and how the U.S. isn't the only one, and they're doing a lot better than other nations. How much do you need Europe to do a little bit better? Do you need China's GDP to come in with a 4 handle rather than the 3 handle that some are expecting in order to maintain your constructive view on U.S. equities?
I think it's an important input. Obviously, the S&P 500 in particular generates a lot of revenues internationally, and if your two largest trading partners are going into recession or slowing meaningfully, that's obviously a big headwind to it. And I think also for political purposes, you'd like to see European growth kind of stabilize given the war in Ukraine. So look, it's an input without a doubt, and also because it's impacted the value of the dollar, and obviously higher dollar reduces earnings generated abroad. So there's a number of impacts here. For me, the number one is growth, though, right? If you're concerned about global recession outcomes, then yeah, you want to see China and European growth stabilize as much as possible.
Stuart Kaiser, thank you so much for being here in studio. We really appreciate it. Coming up, the market moving events that you need to be watching. That's next in our trading diary. In the markets, what we do see is a green across the board, in particular led by certain big tech names, not NVIDIA. That's down and down hard, but Amazon shares up more than 2%. Meta up more than 4%. From New York, this is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Time now for the Trading Tower. You need to be watching in the week ahead. President Biden traveling to Kentucky will get the latest read on inflation in America with CPI on Wednesday, plus Fed speak coming from Evans and Kashkari, U.S. PPI and another round of initial jobless claims on Thursday, and rounding out the week with the University of Michigan Sentiment Survey on Friday. Right now, you are seeing that rally extend. This was Countdown to the Open. This is Bloomberg.
Record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
When U.S. jobs numbers are released,
this is quite a surprise. Just wow.
Bloomberg brings you crucial data at terminal speed.
The headline number, 528K. That takes us back to where we were when the pandemic started.
And instant expert analysis.
That recession talk just got a freezing cold shower.
Powell pivot isn't going to happen, not with numbers like these.
This is the payroll pushback.
When does this become painful?
Quite frankly, the market has 2023 wrong.
Nobody covers jobs day like Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history. mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sci-Fi stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venegold as an opportunity to leave that troubled home. Venegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
You find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous. When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them
is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18.